One of the most common questions for investors is, should I even use a retirement account? And if I'm going to use an IRA, am I using a traditional IRA or a Roth IRA? Well, in today's video, I'm going to break down how taxes work and impact your investment returns when you invest outside a retirement account versus using a traditional IRA or a Roth IRA. Now, quickly, I'm going to break down the three different classifications here. Let's say you're investing outside of a retirement account. When you're doing that, your money is taxed now. Okay, you go make an investment, whether you make an investment and you make money in crypto, real estate, stock, I don't care what it is, you have a gain on your investment. You got to pay taxes to the IRS now. Let's say you're using a traditional IRA instead. The way it works with a traditional IRA is I make money, crypto, real estate, stock, and that's in my IRA. I don't pay taxes now. I pay taxes later when I draw the money out of retirement at age 59 and a half. And then you take the best of all, the Roth IRA, and you invest it, crypto, real estate, stocks, doesn't matter what it is. You have gains going back into the Roth IRA. You pay taxes. Never. There's no taxes in a Roth IRA. It's a totally tax-free vehicle. Now, we're going to come back to the traditional IRA because you might be like, why would anyone use a traditional IRA if Roth IRAs are taxed never? Well, there's one reason why, and you get a deduction when you put the money in. So we're going to break that down. But the first thing I want to make sure everyone understands is if you're making money outside a retirement account, that's going on your 1040. You're paying the IRS. That's eating in 20, 30, 40% of your returns going to taxes. You don't get to reinvest every penny. When you talk about building long-term wealth, that really eats into your returns and your nest egg at the end of the day. This is why retirement accounts in general are so powerful. This is why people have put $44 trillion in US retirement accounts, is because as you're investing and growing that nest egg, you're making investments, you're getting returns on those investments, you're having gains, you're selling assets, that money's all going back in the retirement account and you don't pay tax right now. All right, let's break down the traditional IRA. Now, the traditional IRA is the most popular account out there, but the Roth IRA is the fastest growing account in terms of popularity. There's just more traditional IRAs out there than Roths because it's been around longer. And when a traditional IRA, the way it works is I put money in a traditional IRA as a new contribution. You can do $7,000 a year, $8,000 if you're 50 or older. But when you put that $7,000 in, you get a tax deduction. I get to reduce my taxable income by $7,000 on my 1040. Let's say you make 100 grand a year. You're only taxed now as if you made 93,000. Okay, it reduces the amount of taxable income. And if I'm in, say, a 30% tax bracket, 30% of $7,000 is $2,100. I got to save $2,100 in taxes simply because I put $7,000 in my IRA. And that is the primary reason people use traditional IRA accounts, is the government has said, we will give you tax relief now. We want to incentivize you to put money into your retirement account. We don't want you living on Social Security alone. You've got to have some nest egg to rely on so you're not working until you're 95. This is where retirement accounts come in, and this is the traditional IRA, and this is the number one reason people use a traditional IRA is you get a tax deduction now. The downside of the traditional IRA is the government said, great, go invest it. We give you a tax deduction now. You don't make money as you're investing and growing that nest egg, but when you start pulling that money out at 59 and a half, you pay tax as you draw the money out. So let's say you're drawing $100,000 a year out of your traditional IRA in your 60s, 70s, 80s, that will be subject to tax. If you're in a 30% tax bracket, then you're going to be sending $30K to the IRS in the state. You're only getting $70K a year out of that IRA. All right, so that is the way the taxes work on the traditional IRA. You are taxed later, all right? But you got an upfront tax deduction, which can be very powerful because it helps you put more money in the account, frankly. It gives you more disposable income, and it gives you tax relief now. Trust me, I want to pay as little tax as possible every year, and a traditional IRA is a huge way to get additional tax savings. Now, this is the same for traditional 401ks, by the way. I'm just using IRAs here as the example. All right, let's talk about the Roth IRA. This is the fastest growing account. It's the number one account we have here at Directed IRA. Why is that such a popular account right now, and why is it growing in popularity? Hey, I'm cutting in here because I want to make sure you know all the stuff I'm talking about on my YouTube channel, investing in alternative assets, whether it's real estate or private funds or private equity, oil and gas, crypto, saving on taxes, all these concepts I love and I talk about here. I want to let you know we do this at my company, Directed IRA. So get on over to directedira.com/call and book an appointment with one of our self-directed IRA specialists that'll help you understand how to take control of your retirement. One reason, tax never. As I said earlier, when you pull the money out of a Roth IRA retirement, you pay no taxes. That 100 grand a year you start drawing out of your Roth IRA in your 60s and 70s, well, you get to keep the whole 100 grand. You send nothing to the IRS or to the state. It is not taxable as you're pulling money out later on at retirement. retirement. However, you do not get a tax deduction to put the money in. The traditional IRA or the traditional 401k, you get a tax deduction to put money away. But the Roth IRA, they give you no tax deduction. The deal that the government is making with you there is to say, you need to pay us taxes. We're not giving you a tax deduction on that money you put in the Roth IRA, but you get to pull the money out later, tax-free at retirement. I think that's a pretty good deal. A lot of people look at the Roth IRA and say, all right, that little seed of $7,000 I put in a year, I have to pay taxes on that. But if I can 10x that and every year that 7,000 can turn into 70K, by the time I hit 60, I don't have to pay tax on that 70K coming out. I'd rather pay tax on that little $7,000 seed than pay tax on the 70,000 that's gonna come out later on in retirement as I'm harvesting all of the gains later in my 60s and 70s. And that is the primary reason I love the Roth IRA and why it's the #1 account we have at Directed IRA is smart investors look at that and say, if I can get really good returns in the Roth IRA, that large amount of money that I'm gonna be pulling out later on, 20, 30 years, whatever your horizon is as you're investing in the Roth IRA, I'll pay no tax on the way out and I'll have a tax-free vehicle where I'm never taxed on it. Versus building up $1 million, $2 million, $3 million traditional IRA when you hit 60 and 70 that you're paying taxes on as you pull the money out. So remember, as you're investing your money in stocks, crypto, real estate, whatever it is, and you're doing it outside a retirement account, you get to keep the money now. That's great, you can spend it now. Really hard to build long-term wealth though, because you have to pay taxes on all the money and you only get to reinvest the money after you've paid taxes. When you're using a traditional IRA, you get a great incentive of a tax deduction and that money is taxed later as you start pulling out in retirement. And then the Roth IRA, again, my favorite, no tax deduction to put the money in, but the money grows and comes out entirely tax-free. You are taxed never on the money that you make in a Roth IRA. Roth IRAs, traditional IRAs, don't just have to buy stocks, bonds, and mutual funds. I mentioned buying crypto or real estate in your IRA. That requires a self-directed IRA. That's what we do at our company, Directed IRA, but a lot of other content on how your IRA can own real estate, private funds, startups, crypto. Make sure you click the links below. We've got a lot more resources on investing in these private alternative assets with an IRA. And in the description below, we have our beginner's guide to self-directing where we go over the rules and structures on how you can own private assets like real estate, crypto, private funds with a self-directed Roth IRA or traditional IRA. Please reach out to our team if we can help as well. I'm Matt Sorensen. We'll see you next time.